Welcome. Today, we are taking a hard look at the books of a major player in the Turkish financial sector.
We are. We've got the 2025 consolidated financial statements and the annual report for Ulusal Factoring ahead right here.
And our mission today, really, is to decode all of this for the retail investor. You have to cut through the accounting fog and see what's really going on.
That's it. To find the real story behind their 2025 performance.
Okay, so let's first get to know the company a little. Ulusal Factoring was founded back in 1999. Its headquarters are right in Istanbul.
And it's important to stress, unlike a manufacturer, they don't have factories or, assembly lines.
Right, they're a pure service provider.
Exactly. Their core business is factoring. I mean, think of them as the engine oil for small and medium-sized enterprises.
Okay, so how does that work?
Well, when an SME is stuck waiting for a customer to pay an invoice, Ulusal steps in, buys that invoice, and gives them cash right away. It solves that immediate cash flow problem.
And it looks like they're trying to modernize that engine. They have a subsidiary, 100% owned, called Ulusal Finance Teknolobayili Eshu.
Yeah, which points to a heavy focus on fintech. It's a smart move. And, speaking of smart moves, if you look at their governance, there's a statistic that really jumped out at me.
The board composition, right.
The ratio of female board members is 50%. In the finance world, that is a massive green flag.
It suggests a very modern, progressive approach to management, I'd say.
It definitely does, and it backs up their market position. They're a leader among non-bank factoring companies. They're on the stock exchange, BSE Keo, ULUFA, and they have a solid rating.
An AA long-term national rating from JCR Eurasia.
Correct.
So a quick SWOT analysis then. Strengths are obvious. That strong branch network, the high credit rating. Opportunities.
The growing need for SME financing in Turkey, that's a constant. But the big threat, the one looming over everything.
An interest rate environment.
Exactly. When borrowing costs go up, it gets expensive for absolutely everyone, including them.
Now we can move on to our analysis. And this is where the numbers start to tell a pretty tricky story when you compare 2025 to the year before.
It really is. It's a classic case where the top line and the bottom line are telling two completely different stories.
So let's start with that top line. Revenue, specifically their factoring income. It surged to 8.36 billion Turkish lira.
That's a huge jump from 5.9 billion in 2024. I mean, they are moving a serious amount of money.
They are. But here's the plot twist. Despite all that revenue growth, the net profit actually dropped.
It did. It fell to 748.5 million TL, down from 898.6 million the year before.
Wait, hold on. So they brought in billions more in revenue but ended up keeping less profit? How does that work?
That's the squeeze. Their operating expenses and, maybe more importantly, their interest expenses went way up since their raw material is cash and they have to borrow that cash.
The higher interest rates just ate into their margins.
Totally. And you can see that borrowing right there on the balance sheet. Their financial liabilities, their loans, spiked to 12.5 billion lira.
And they issued a lot more securities too, right? Bonds?
Yep, about 1.7 billion in bonds. That leverages their business model, but it comes with risk. You also have to look at the quality of the assets.
You mean the loans they're holding?
Right. Their non-performing loans, the NPLs, rose to 1.19 billion lira. That just means more of their customers are struggling to pay them back.
They did seem to strengthen their capital base, though. Their paid-in capital quadrupled to 540 million. But we really need to address the gotcha in the report. The auditor's limited positive opinion.
This is a critical nuance for you to understand. The company booked 93.46 million lira in income from a sale and leaseback deal.
And they did this to take advantage of some tax exemptions.
Precisely. But the auditor flagged it. They explicitly noted that under the accounting standards, TFRS 16, that profit shouldn't have been booked in that way.
So practically speaking, their reported profit is technically inflated by about 93 million lira.
That's the takeaway. It puts a pretty big asterisk next to that bottom line number.
Okay, so to summarize everything, Ulusal Factoring is growing aggressively. I mean, over 8 billion in revenue is huge. But rising borrowing costs are really squeezing the bottom line.
And there's that specific accounting choice for tax reasons that's inflating the profit numbers you see on paper. Strong volume, but they're driving uphill against costs.
If this breakdown helps you understand the real story here, please consider evaluating our channel membership. It really helps support us making ongoing videos like this one.
It really helps us keep the lights on.
And don't forget, you can always hit that super thanks button to show some extra love. Please like, subscribe, and share this with your investor friends.
We'd appreciate it.
And we'll leave you with one final thought. With borrowing costs likely to stay high, can Ulusal Factoring's revenue growth continue to outpace their debt expenses in 2026?
That is the billion lira question, isn't it?
Thanks for listening. Catch you next time.